Hello traders, what's going on? So it has been a while since I created a public video, and I believe that now couldn't be a better time because we have one very important topic to discuss. And it's a very simple topic. Has the market bottomed? Should we start bottom picking all the tech counters, your Apple, Amazon, all these growth counter, and then we are going to the moon. S&P is going back to 5,000. Are we in that situation right now? So if you are here for a short yes and no answer, right, I think it's a little bit more complicated. So let's dissect this situation one by one on various factors, and we shall take a look at what are the action to take and what is my personal view on this current trend. Okay, so before we begin, right, let's do a quick time check. Today is 21st of July and the time now is 3 p.m. So first, before we talk about whether the market has bottomed or whether the market is going to continue to rally up from now, right, we must first understand why did the market went down in the first place, because by understanding that, it kind of let us know what is the market expectation, what is it pricing in, and whether or not this rally is a bear market rally or is it a true market bottom. So one of the key things that a lot of people feel this is the market bottom is for a few reasons, and most of the reason they are all technical based, that there isn't really a fundamentally driven reason, which is something that I'm sort of not very okay with. If the market want to rally, if the general trend, the bigger trend of the market were to change, right, it has to be driven by economical and fundamental factors, and we will use the technical to confirm these fundamental factors. But what I believe happening right now is people are looking at this sort of this rally, this technical breakout, and then they are trying to pull whatever fundamental reason that they can find to kind of justify this technical breakout, which I don't believe is the correct approach to identifying a major trend change. Okay, so let's talk about why the market dropped in the first place. And one of the most critical market movement during this year was the March rally. Okay, so mainly let's look at the federal fund rate itself. So I think by now everyone should already know that the market is dropping because of the Federal Reserve rate hike. And not only that, we are also hiking into an economic slowdown. A lot of companies are cutting jobs, there are hiring freezes, especially those growth tech companies. And not only that, we also have a surprise negative GDP for the US in Q1. So with all these things combined, plus the rate hike, plus we have QT, the unloading of Federal Reserve balance sheet, right? Of course, all these reasons contributes to the stock market dropping. So let's take a little bit closer into the Federal Reserve rate hike. And of course, the all-important inflation, the CPI data. One of the things that confuse a lot of people right now is that previously, whenever we have a CPI data that was released and the reading comes out to be higher than expected, market kind of dive all the way down. We see that in April, May, and June. But in July, even though the CPI data came out to be, wrong screen, the CPI data came up to be one of the highest reading for the year, market rallies instead of diving down. And that led a lot of people to kind of like confused a bit, like not sure what is going on, especially if you are a bear that is late to the party. It's like you look at the market, you see that CPI data came out, market dive. CPI data came out, market dive. CPI data came out, market dive. And then right now you think, okay, I will short really. And then when you decide to short right now, market kind of go against you and you are probably left confused. Okay, so the reason is that CPI data is more of a middleman rather than the exact cost. So what I'm trying to say is that whatever we get on the CPI data, it will determine how much the Federal Reserve is going to hike. So it has this interconnected relationship. So for the first half of the year, every time the CPI data come out and it has a higher than expected reading, Federal Reserve increase their pace of rate hike. Initially, they did a 25, then after that, they did a 50 BPS. Then in June, we have a 75 basis point. So that was the trend, that was the expectation that is set by the market. And due to that, right, market kind of already sort of price in the future rate hike. So for example, when the CPI data for July came out and it was 9.1%, which you can see right here. If you were paying attention on the day itself, market actually kind of dived down. And not only that, 4 days before the CPI data came out, market was already going down because it kind of believed that, okay, this month the CPI data will be back. Federal Reserve will most likely do a 100 basis point hike because previously it was 25, 50, 75. So if this round, if the CPI reading is higher, most likely it's going to be 100. So market was ahead of the Federal Reserve decision and they sell down first. Okay, they decide to sell down first, which is what you are seeing in this 4 consecutive candles sell down here, which is on the 11th of July, 12th of July, 13th of July, and finally 14th of July. Then right after the data came out, Federal Reserve came out and say that some of the FOMC members came out and revealed that actually they are not keen on a 100 basis point hike. They want to stick to 70 basis point hike. So because of this news, the trend is sort of broken where initially we have 25, 50, 75 and the market pricing in 100. But now we have a Federal Reserve rate hike that is kind of like decelerating. They are going to slow it down. They are not going to accelerate the hike further. They're just gonna maintain at 75. And immediately right after that news came out, market kind of rallies all the way up, all the way up. So from here, right, we can sort of understand or we can sort of assume that this price level that you see here, 3,750 to 3,009 is kind of, I will call it the 75 basis point zone. Sorry, 75 basis point zone, okay? 75 basis point zone. So anything below is Federal Reserve probably decide to hike higher than 75, okay? And this is kind of supported by the fact that previously, when the actual hike took place in June, it was this 2 candle. It was a 75 basis point hike. But even before that hike take place, right, market already priced in the hike and it has sell down already. Similar to what we have seen here, market sell down first. But after the market sell down and the actual hike took place in 15 or 16 June, right, price doesn't go down further. It kind of like stagnant there, remains sideways there. So this sideways sort of let us safely assume that, okay, this is where the market have priced in a 75 basis point hike for July, for the coming week, okay? So if the CPI data came out to be worse, most likely market is gonna price in 100 and it's gonna go down further, which did happen, but because of Federal Reserve trying to go back and claim that they are not interested in 100 BPS hike, the market rallies. So that's the main reason for market rally. I mean, it's not fair to say that Federal Reserve go back on their words because they didn't promise a 100 point hike in the first place. It is what the market assumed. So let me just bring up a table for you to see. So this is the Fed fund rate for the year 2022 and the hike that took place during the FOMC meeting. Okay. So for the first half of the year, right, we can see that the Fed fund rate from 0.25 went up all the way to 1.75. And the hike is actually accelerating from 0 BPS, 25, 50, 75. But in July, we are sticking to 75. We are not going for 100, even though the CPI data is higher than expected. Not only it was higher than expected, it was a lot higher than expected, and it was a lot higher than the previous month also. But regardless, Federal Reserve say, no, we are just gonna stick to 75. And another thing that I want to point your attention to is, if you look at this table here, right, you will see I have box 2 information, but let's look at the below. I hope you guys can see it is a little bit small. Federal fund rate projection. Okay, federal fund rate projection is the Fed fund rate that they are projecting for the year. So for 2022, the FOMC is projecting a Fed fund rate of 3.4%. Okay, 3.4%. And in March, right, they only projected 1.9. In March, when they have their FOMC meeting in March, they projected 1.9. But now it almost doubled. The federal fund rate projection is almost doubled to 3.4. So you can actually find that information on their website itself. So this is the summary of economic projection, otherwise known as SCP, and it was released on June 15 on the June FOMC meeting. And within the second page itself, you can see the data here already. Okay, so you can go and take a look at this by yourself. But what is important to know is that they increased the federal fund rate projection to 3.4, and in March it was 1.9. So what does this mean? This means that currently the Fed fund rate is at 1.75. So in July, right, the current consensus is 75 BPS. We don't really know the actual number yet. I mean, we will know next week, but of course, right now, let's just assume that in July, this month, Federal Reserve is going to hike by 75 basis points, which means it will bring the Fed fund rate to 2.5. So if Federal Reserve want to achieve a 3.4% Fed fund rate by the end of 2022, right? You will notice that there is actually no room for 100 basis point hike right now. Perhaps they can do a for example, there's 3 more hike to go. There's actually 3 more hike to go, but there is room for an additional 100 BPS hike. So they can do like a 50, 25, 25, or they can do a 25, 25, 50. I'm not sure. That's up to them also. But the thing is that if they were to follow what they have projected, right, then it is likely that the hike that they are going to do is gonna decelerate. Initially, it was accelerating, but after that, it's gonna decelerate. And this 75 basis point hike in July, the current consensus, okay, kind of confirm that the federal rate hike is gonna decelerate, which provide the market some much needed good news to rally. Okay, so whether or not Federal Reserve is gonna decelerate the hike, whether or not July is gonna be 75 basis point hike, we don't really know. It is not sort of confirmed, but the market is acting like it has confirmed. The market is sort of pricing in that all these things is confirmed already. We are not going to wait for the data. We're going to rally first. We're going to rally first. Then after the data come out, if it is something else, then we don't know. So that is what I mean by irrational rally. Market is rallying based on things that are not confirmed yet, but that is the nature of stock market itself. Stock market always forward looking. It is always forward looking. It will rally first before things happen. And when things actually happen, right, depending on whether it happened via the market expectation or is it out of expectation or below expectation, then the market will readjust. That's why you will see all these extremely stupid rally that goes up like 100%, 200% during 2020. And then right now, all these counters are dropping left and right back to where they have started. So because of this forward-looking nature of the stock market, right, it is very easy to get caught in this kind of irrational rally. So let me just give you an example of an irrational rally, which previously I mentioned that this March rally was one of the most important period in 2022. Okay, so first, this rally happens mainly due to the 25 BPS hike by Federal Reserve. Because when the initial sell down occurs, I believe that this sell down, the market was pricing in 50 BPS hike. In January, February, right, market was already pricing in a 50 BPS hike, which is supported by the evidence that you see here. Because in April, we have the 50 BPS hike here, which is back to the same bottom here. Okay, this 50 basis point hike that happens somewhere around here is like around this same level here. At the same time, right, when the 75 basis point hike was pricing, right, it went further below already. So this bottom in March, it was pricing in a 50 basis point hike. But in March, what happened? We have a 25 basis point hike instead of a 50 basis point hike. So the market rallies all the way up. And this is an irrational rally, mainly because Federal Reserve believe that the 25 basis point hike is enough to tame inflation. Okay, Federal Reserve believe that, okay guys, inflation is transitory, 25 basis point hike is enough, and the market also believe that. And then we have one of the most aggressive rally that we have seen in 2022, and it was a much needed rally also. It went up close to 500 points, 12%, close to 12% from the bottom. And not only that, it definitely lured a lot of bulls in, trapped a lot of bulls here when there was a resistance breakout. Excuse me. It definitely trapped a lot of bulls when it broke out through the resistance there. And after that, whoever who bought the breakout was trapped there. And most of this rally was fueled by Apple, where you can see this series of green candles. We have not seen this many green candles in a row for Apple. During this period, I was watching Bloomberg, and one of the analysts said that the last time Apple rallied this much was when they didn't even invented iPhone yet. iPhone wasn't even out yet. So you can kind of see the aggressiveness of the bear market rally. Okay, but when the CPI data came out on April, and the data show that, oh crap, 25 basis point is not enough. We probably have to go 50 basis point. And what happened? Market dive all the way down. All the way down. Okay, and somewhere in May, when it in May, when CPI data came out again, and it seems that, okay, maybe we need a 75 basis point, it went down some more. Okay, so now that we know why the market dropped, it is mainly due to expectation of the Federal Reserve hiking. It's not due to the CPI data itself. And this rally, I will repeat again, it is caused by the decelerating in the Federal Reserve rate hike, or rather the expectation of decelerating. Okay, So whether or not it's going to decelerate, we don't really know yet, but the market is already pricing that in. So this leads us to another, I would say, another conundrum. First, let's go back to the SCP table, this projection here. So let's look at the PCE inflation. Okay, so PCE inflation is the matrix that Federal Reserve used to measure inflation. Normally, we will look at CPI because CPI include energy and food, but PCE doesn't include energy and food. But that is another topic altogether. I won't go into that. So when you look at the June SCP, right, the PCE inflation, they projected 5.2 for the end of 2022, okay, 5.2%. And in March, right, they actually projected only 4.3. So when June's come around, they realized that, hey, actually 4.3 projection is not realistic. The inflation is really spiking up very high. So in June, right, they projected 5.2 for 2022. And based on the PCE inflation, right, based on this PCE 5.2 inflation, they will also project how much they need to hike. So these two numbers are correlated. And that is why you see that when the PCE inflation in June was revised upwards compared to March, the federal fund rate was also revised upwards compared to March. So this 3.4% Fed fund rate is projected based on the PCE projection of 5.2%. Hopefully that's not too complicated. I think it's quite a simple concept to understand. But the key thing here is in June, we have the PCE data and it is 6.3%. So that is way higher than what we are looking at in 5.2. Way higher than what they have projected in 5.2. And because of that, right? Because of that, we have to assume that in the second half of the year, this PCE data is going to slowly go down to meet the 5.2 projection that they have made. And based on that, we can assume that the federal fund rate at the end of the year will be 3.5. And then because of that, we can assume that the rate hike is decelerating. But what if in August, September, October, the PCE spike up? And the PCE spike up because the rate hike wasn't enough. And the PCE spike up to like maybe 7% or 6.5%. And that will mean that this 3.5 Fed fund rate projection is no longer valid. Maybe they need to do a 4.5 projection, or maybe even 5.0 projection. I mean, I don't think we will go to 5.0, but perhaps a 4.0 projection will be realistic. Or if the inflation is really, really very bad, then maybe a 4.5% federal fund rate. And if that were to happen, right, it means that in the next 3 rounds of the FOMC meeting, September, November, and December, right, Federal Reserve have to sort of, they will not be able to decelerate their rate hike. They need to either maintain or they need to accelerate some more. That is the worst case scenario. And when that happened, right, the market, which is currently already pricing in a decelerating rate hike, might start to U-turn down because the data is so bad. They were ahead of themselves, and then after that they were like, hey, whoa, the inflation is still high. The Federal Reserve decide to raise their Fed fund rate expectation for the year, and the market can U-turn down. Okay, so that is the current issue that we are having right now. And there's another reason for why this market rally is very irrational, and that is mainly because the earnings. So we already have the bank earnings. We also have Netflix earning, which came out, and not so much in focus, but we also have DR Horton earning, which is a major home builder, lah. Okay, a major home builder company. So looking at all the banks earning, mainly JP Morgan, Morgan Stanley, Bank of America, Wells Fargo's, and Citigroup. So all these banks, right, they have a lot of what I would say consumer information, consumer trend information, because they don't serve the high net worth people. They serve the normal folks, okay, like personal banking rather than high net worth or private funds or all those stuff, okay. So as I was looking through the bank's earning, in fact, on Patreon, right, we actually did a deep dive into Citibank versus JP Morgan. And we realized that the earnings were not really spectacular. They were more of, okay, we didn't do so bad, rather than, hey, this earnings is really good. In fact, majority of the banks, they made less than what they did in the last year of the same quarter, compared to 2Q 2021. They actually did quite bad, lah. And only Citibank was able to meet their expectation among the bank earning. I'm not sure about Goldman Sachs, because I didn't really look at Goldman Sachs, as it is not really a bank itself, like a consumer bank. So only Citibank was able to sort of beat the expectation, but the expectation was very low. The expectation was set very low in the first place. So if I were to look at Citibank's earning without all this expectation stuff, right, it seems like they are not really doing that well also, lah. And same thing with Netflix. Netflix earning was pretty bad also. They actually lost 1 million customer, but their defense was like, hey, we didn't lose 2 million, we only lose 1 million. So the amount that they are losing is less than what they have projected, lah. Okay, so we are having this situation where market is rallying on earnings that are not as bad as it should be. And if we were to see this kind of earnings in any other market environment, right, most likely it will probably lead a sell-off rather than a rally, lah. But between earnings and the Fed fund rate projection, right, I do believe that the Federal Reserve expectation to probably not hike 100 basis point, because they say that 100 basis point is not on the table. I think that contribute a bigger weightage to the rally compared to the earnings of this company. And because of that, right, if in the future, sometime in August or September, if the earnings is like quite bad, or sorry, if the inflation data is still bad and Federal Reserve need to adjust their projection, right, then it may cause a very big sell down that can happen. But I believe that we don't even need to wait until August, because in the coming week, we have the big tech earnings. We have Apple, Microsoft, Google, and Meta, Facebook. So we have these 4 big tech earnings that is coming up in the next week. And these are the big heavy weightage of the S&P 500, especially Apple, and even the Nasdaq itself. And not only that, we also have FOMC rate decision that is coming up in the same week as the big tech earning. And now the market is already rallying very aggressively prior to this meeting. So if the earnings were to disappoint just by a little bit, the market can actually fall. Apple can actually dive, even though they give a good earning, this and that, blah, 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 Apple might actually drop because it has already rallied. It has already rallied prior to the news itself. It can become those situations where buy on rumors, sell on news, those kind of situation. But more importantly, right, in the FOMC meeting, what is important is not really the hike decision, but rather what Jerome Powell is going to say. So he will probably make some statement on the future outlook. And this future outlook is very important because if Jerome Powell say, hey, okay, for the year of 2022, we believe that our Fed fund rate projection of 3.4% is a bit low, we need to revise it higher, or we feel that we need to be more aggressive in July, blah, 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 all this kind of thing, right? Then we don't even need to wait for August data to come out. The market can just dive down first because market is always forward looking. So it is very dangerous to pick the bottom right now, mainly because the coming week is going to be extremely volatile with the big tech earnings plus the FOMC decision. So if let's say after next week, when we go into August and market is still able to retain its high above 4,000 level, for example, market is able to stay above 4,000 level after the big tech earnings came out, everything looks okay, and it has retested the support several times and the support is holding, then perhaps I will be more inclined to maybe call this a bottom, or perhaps if Jerome Powell says certain things that sort of ease the market a bit and the market is able to remain above 4,000, then maybe I will be like sort of give it a benefit of doubt and say that, okay, this is probably 40% bottom or 50% bottom. I will not be as bearish as I used to be. But even then, right, even then, looking at a lot of the economical data that we have right now, it doesn't seem like it's gonna bottom lah. It doesn't seem like it is going to bottom. But of course, we are definitely not going to shock into this kind of very bullish price action, and we are not going to place any more trades prior to one of the most volatile week that we are going to face this month. I think it is an extremely dangerous decision because yes, I am still bearish, but if I decide to place a lot more shorts and then next week everything just continue to aggressively rally onwards, right? Then you put yourself at extremely unnecessary risk lah. Same thing for long position also. If you decide to long this breakout because you feel that this is the bottom, this and that, and when next week comes, the earnings it was good, but it wasn't spectacular, and the FOMC meeting, Jerome Powell said something, I don't know lah, he always flip rata one lah, and then the market decide to U-turn, and then you are caught up there also, okay? So for both and the bears, right, if you are looking at the market at this point and you are sitting there wondering, should I pick a direction right now? Should I start putting in more position, especially if you're holding on to a lot of cash, right? Like you are just waiting to pick the bottom or waiting to short the top, that kind of thing. My advice is wait for another week. Wait until the next week is over. Wait until everything blows over first. And next week, we also have another important data that's coming out, that is the second quarter GDP reading for 2022. So if the second quarter GDP reading is a negative growth, right, then we officially have a recession. But of course, that is a very lagging data. I don't think it will affect the market in any way, but it does give us a good idea of the kind of economical condition that we are in. Okay, so currently, if you have a lot of position, stick to those positions, stick to whatever trade plans that you have. There isn't a need to go and jump into this market right now because a lot of things are question mark, and we will not really know until after next week where things settle down a bit. Now, let's look at things on a technical level also. Let's look at S&P 500. And one of the things that I will believe that is considered very bullish is because it broke out of this resistance now, okay? It was ranging for a bit and then it broke out of this resistance. And not only that, it is sort of able to stay above that resistance for 3 days already, 3 days already. But you can see that there's a little bit of selling pressure coming in. And if we decide to suddenly rally upward, right? I am still not inclined to chase this, mainly because if any rally that market does before next week, it is setting itself up for a big fall. Because the more it rallies, right, the higher it expect from next week earnings, or the more it expect from Jerome Powell to say something that is not very bearish lah. And if he say something slightly bearish, that is gonna just drop a lot. So if you get caught there, right, you can lose a lot. But if let's say the market is a little bit more rational, it kind of hang around there, it is also waiting for next week. And if next week everything come out very bullish, then we can buy, and then maybe that will be a much more healthier approach lah. So no matter what the price action is going to happen prior to the FOMC meeting and the big tech earnings, right? I'm not going to chase, I'm not going to short, I'm just going to wait and see what is going on. And you also have to remember that in a bear market rally, right, there's a lot of fake breakout that you have to be very wary. I'm not saying this is definitely a fake breakout, but previously we have a fake breakout here. We also have a fake breakout here. Of course, this is a legitimate breakout, but it was a irrational rally lah. Okay, and we also have like a very tiny fake breakout that happened here lah. That kind of like want to go out like that. So like, I mean, if you look at this right now, it does seems like, wow, where got breakout is like very obvious is going down. But if you rewind back, right, if you rewind back and then you are looking at this, and then you see that the opening price go up, right? You are going to chase this because hey, this one resistance, support, wow, uptrend already, this one double bottom. And then the moment you chase, everything drop all the way down. So you need to be you need to be able to pick out all these kind of technical stuff lah, and not look at things from a hindsight perspective. Okay, so if let's say market continues to rally, right, the critical level, the very critical level is here, 4200. This is a very critical level. This is the, I would like to call it the 50 basis point level. This is the 50 basis point level. So in order for market to rally up until there, right, I believe there's a lot of fundamental drivers that needs to happen. Meaning in the coming month, the CPI need to ease a bit. It need to go down. The PCE need to sort of goes down to meet the Federal Reserve expectation. And if that happens, then it kind of support the federal fund rate projection given by the Federal Reserve. They are probably gonna stick to their 3.4%, 3.5%, 3.4%. And it will mean that yes, this current expectation of the hike decelerating is confirmed. So market is gonna use that as an excuse to rally higher, okay? And on top of that, maybe the earnings were very strong, or all the earnings come out to be extremely strong, extremely good, and things just rally higher. And after that, the inflation just continue to ease, and Federal Reserve say that, hey, we have achieved soft landing and we have inflation under control already. And it can also be helped by perhaps the Russia-Ukraine conflict sort of ease away also. So there's a lot of pieces that need to fall into place for this to happen. So if all those pieces fall into place and market break out above 4200, then yes, then I will confidently say that we have a bottom. But what we do not want is, we do not want a situation where market do an irrational rally, meaning it's going up to 4200 level, but at the back end, all the data are showing all the negative stuff like we have no idea why is the market rallying in the first place. So it is an irrational rally. And then when the data eventually come out to say that, hey, things are actually quite bad, then what's gonna happen is it is gonna dive back down. And what if it does this, right? I believe it could be the same situation as what we have in March. It is an irrational rally, meaning the inflation is still not going away. Things are still not getting better, and we are still in a same situation lah. But it's even worse because previously, when we have this irrational rally, the Fed fund rate was only 0.50. And they have been hiking in order to tame the inflation. But right now, we could end up in a situation where the Fed fund rate is already at 2.5 and we are hiking, but we still haven't tamed inflation. The inflation is still going up. And the longer that we are in this state, right, the worse it is for the economy and the worse it is for the stock market. So that is looking at things from both technical and macro fundamental perspective. We need to understand why the market is diving, why the market is rallying, and we need to try to guess what the market has already priced in. So if we are able to effectively guess what has the market priced in, right? Then based on whatever data that came out, we will be able to sort of like, hey, the market did not price this in, we can short. Or hey, I think we better not long this position because market already rallied. It has most likely priced in this good news already. In fact, maybe it might retrace based on the good news. So I think these are very, very important. And also consider companies like Apple that already rally 17% and it break out of the previous resistance. And also Amazon, not as strong as Apple, but it also have rallied 20% from the bottom and it has not break through this yet. Okay, so all this rally is kind of like happening prior to the FOMC and the big tech earnings. So when the earnings come around, it is quite possible that despite good earnings, right, they can still U-turn back down, mainly because they have already priced in the good result. They have already priced in. But what if the result is bad? Then they are going to go down even more and it can be dangerous, especially if you are trying to bottom pick this week. So this rally, if it is indeed an irrational rally, then it will give us the opportunity to short certain counter at a higher price. And if this rally is justified going forward, then we can pick up some long position when it retraces, when the support is held. So for me to buy into this rally, right, I will probably want to buy a support, but I also want to see all the supporting data that I've mentioned. So I'm not gonna simply buy via a technical analysis. I will want to see some data, supporting earnings, but so far both the data and earnings are quite bad. And I will use technical analysis to confirm, to time my entry in. And from there, right, perhaps we may have a bottom, but for now, not yet. For now, not yet. For now, I do believe that the market rally is irrational, and once all the data come out, and then Federal Reserve probably gonna do some prata, and then the market is gonna U-turn. Okay, so that's my view for now. But as mentioned, right, I will not be adding any more shorts until after next week. And currently, we have also took some loss on our short position. Of course, we can't have everything profit lah. So we did took some loss on 2 short position very recently. Wait, let me bring up data. So we did took loss on Cortera, unfortunately, and Pool Corporation, which was entered very recently also, and the market just continued to aggressively rally upwards. So it was hit with a stop loss. But despite the latest loss, we are still, our year-to-date ROI is still close to 19% lah. And this is a very, I would say, a modest gauge on performance, mainly because this one just assume that you are just blindly copying lah. You are not doing any due diligence. You are just blind copying or whatever that I recommend via Patreon. But of course, if you are a little bit more, I would say, independent trader, you'll probably add in additional position. You'll be able to increase your lot sizing a bit here and there. Those kind of stuff lah. Okay. So far, I'm not really worried. I'm not, my position is still very, very healthy for the year. So if I were to lose maybe 2 or 3 positions during this rally, right, I will believe that okay, so be it. And if market decide to dive after this rally, then it just means that I'm able to short a lot of the trade at a higher price. I was just temporarily taking a loss previously, and then now I'm able to short higher, and I'll probably able to get back most of the loss that I cut during this period lah. Or if I need to go for the long position, then good, because I have already cut some of my trades, and then my capital is free up, and then now I'm able to adjust back into long position. So the worst thing that you want to do right now is blindly holding on to position. You do not want to hold beyond your stop loss, or you do not want to average down some more when you are already losing, and then when the market does something that you are not prepared for, most likely you are going to lose very big. So it is important to have all these projections and all these things planned out in advance, and have a clear direction on what you want to do and what you are going to do, and ensure that your portfolio is able to adjust at any moment. Okay, guys, so that's basically what I have for this session. For the bears out there, hopefully you are prepared for any kind of bear market rally and you are not overexposed. If you are a bull, just wait for the data to be clearer lah, and not get trapped, not get bull trapped here lah. If the next week earnings and Jerome Powell decide to do prata. Okay, guys, have a good day.